In this session, we're going to be looking at principally at the balance sheet in detail. So we're going to be going now into some of the technical aspects of the general reporting structure that we talked about in the previous lecture. These are the learning outcomes that you can read at your leisure. There are three major statements and that we were talking about in the previous session. Well, we talked mainly about the income statement or the profit and loss account and the statement of financial position or balance sheet. The statement of cash flows we did mention briefly. We had a look at that on the Rolls-Royce accounts, and although it sounds very important, for reasons that will become clear later on, it's not adding greatly to the other two statements. The relationship between them is as follows. I think that's reasonably satisfactory. Self-explanatory. The statement of financial position, the balance sheet, is at a point in time. It's at the year end. Income statement is what happened over the year. You earn your income over a period of time, but the value of your assets, of what you own, has to be at a point in time. So the statements of financial position are as at statements, and cash flows and income statements are for the year ending, or month if it's management accounts. Now here we have two terms that you probably will have heard of: credits and debits. Credits, normal word creditor, means the same as in normal usage. Debits is slightly different. We talked about the claimants, the shareholders, the bondholders, and the creditors. Creditors we called suppliers in the previous lecture. So in the main, creditors are suppliers. They have a claim on the company, right? And the company reports that claim in its balance sheet. How much we owe our creditors at a point in time, how much we owe the bondholders, and the value of the shareholders' interest in the company. But it is the company that owns the assets. It is a separate legal entity. You sue the company, you don't sue the shareholders. And that is the great innovation of the 19th century of limited company. So it's this separation of ownership, and the company owns the assets, is the legal owner of the assets. So a company is a bit like a person in every respect except that it can't walk down the street. So the assets, land, buildings, machinery, debtors, they're all value that is owed to the company, right? Value, and that's what a debit is. That's where something is owed to you. They're a debtor. Right? Oh, that's it, isn't it? Of course, it's from the word debtor. They're debtors. Where it's a person, we call them a debtor. If it's a building, well, we don't call the building a debtor, but it is, in financial terms, it has value which is owed to you in the same way as somebody who owes you money, where you is a company. And then the accounting equation, as it's called, is in various levels of detail, but in its most generalized form, it is the value of the claims on the company should equal the value of the assets of the company. If the assets of the company do not meet the value of the claims, then there are losses, which are like the balancing figure, so that it does balance. If the value of the assets are greater than the claims, then it means something is wrong with the accounts, because the company cannot own goods without it coming from somewhere, right? It's not an owner of itself, if you like. So it has to be equal for the accounts to be a proper representation of the assets and liabilities of the company. Again, we use the term liabilities as a general word for the claimants. How do we identify an accounting asset? Well, we've been talking about debtors. So some accounting assets have no value, like at the end of the year, the wages you've paid during the year is a same as a payment for a building, if you like. But if you pay money for a building, you've got the building there as an asset at the end of the year. It still has value. If you pay money for wages, it's still a payment, but there's no value left. It's all been used up. So there is an issue with the expenditure side as to whether there is still value left in that spending. And that is the problem of identifying an asset. Is there any value left in the expenditure you made? This is a quick rundown of the kind of questions one might ask. It's not a formal model, it's just an explanation, if you like. So, is there a future possible economic benefit? Well, if it's wages, it's been and gone, it's been paid for. Does the benefit arise from a past transaction or event? So if you bought a building, yeah, you must have bought it in the past. Is there a right to control the resource? Yes, it must have ownership. We talked about that, ownership there. Can the resource be reliably measured in financial terms? That's an issue. You may have bought something with the idea of using it for some very profitable activity, so it might be very valuable to you, but actually we can't really measure that profitable activity until it happens, and therefore we're not going to include it as the valuation. That kind of judgment is addressing this issue is, can it be measured in financial terms? If it's no to any of those questions, then it's not an asset. If it's yes to all of those questions, then it is an accounting asset. The claims side of things, we've been talking about that, equity or shareholders, as they're also called, liabilities, the lenders and the creditors, the bondholders, lending in a formal manner, a bit like a bank lending, of course, bank overdraft. So there's no interest in the management or direct interest in the profits, but they can petition the courts for bankruptcy if not paid. We have mentioned that, and it's worth repeating. So they have this great sanction, this sledgehammer that they can take to the company. The accounting equation we've addressed in very basic form when we were looking at this. The claims, the credits must equal the debits. Sorry, these are the debits, the assets, and these are the credits, the equity and the liabilities. So this is what the business owes to the providers of finance, and this is what the business owns. And as we were saying earlier, the two have got to equate. Now, here we have the equation in action, if you like, and I've got three transactions here which are cumulative. So it's like a little financial story, if you like. The owner starts a company with £20,000. So how would that work in our equation? Well, we would have assets would be £20,000, that's what the company owns, and it would owe shares worth £20,000 to the shareholders, the owner in this small company. Then the company buys a van for £5,000. In this case, the owner will also be the director, so there's this kind of dual role for a small company, and that's very common. So he buys a van for £5,000. So some of the asset cash will have moved out of cash and become a van. So now we've got our assets split up into 15,000 and 5,000. Then we get a loan from the bank for £1,000. So that increases the liabilities, increases what the company owes. So that's the loan for £1,000, and that increases the cash. So it's now 16,000. So with this and all transactions, the accounting equation must balance. We must, if some transactions will just be an increase in one asset and a decrease in another, as in cash purchase. Some transactions will be simply a change in on just the right hand side. So just trying to think what that might be, but anyway, those are probably quite rare. So so there might be some changes that just involve the right hand side, and other changes will involve both sides. There may be an increase in both sides, there may be a decrease in both sides. So every transaction is going to in some way affect our accounting equation, but all transactions must keep the accounting equation equal, and in the common terminology, the accounts must balance. So sorry about that. If we look at the group consolidated balance sheet for Tesco, you can see here that we've looked at the assets, the blue dots, and the equity down here is the red dot, and the liabilities, the yellow dots. And we have our basic accounting equation: assets equals equity plus liabilities. So our total assets are 43.9 thousand million pounds. 1,000 million is a billion, so 43.9 billion equals 8.6 plus 35.3. 8.6 down there, and the 35.3 is that one and that one. You frequently have to sort of be wary of the positives and negatives, and remember that they fit into the equation. So they put a negative just on the way they've presented it, and we'll be talking about that in a moment. But that's just because they've taken the liabilities to the other side, and therefore it's in common algebra. It's going to be assets minus liabilities equals equity, and that's what they've done. Assets here minus the liabilities equals the equity. That's one way of presenting it. Well, I chose Tesco's, and earlier in writing a textbook I chose Rolls-Royce. Every company I choose seems to fall into scandal, or maybe they've all got scandals somewhere. Shareholders were misled by information inaccurately provided to the market with knowledge by management. Goodness me. And serious fraud office. So 3 former Tesco executives charged with fraud and false accounting, right, as part of a continuing criminal investigation. So you can have a look at that, but it just emphasizes how important these statements are taken as an indication of the performance. It's a very serious matter, and as you can see, if you do not conform to the accounting regulations and try to deceive shareholders, you can end up in court. And the affair damaged the company's share price, which has fallen around 20% since 2014. So these things affect the future of a company and hence its value. Now we can play around with the accounting equation in a number of ways. This is just a common extension of that equation. We've got our assets on the left hand side. we've got our equity, and we've got our liabilities. But the profit or loss represents profit or loss due to the shareholders. So it's a measure of the change in equity holding. And nowadays there is in fact a separate statement in the annual report detailing the transactions that have led to a change in the equity holding. Some of that profit is going to be distributed to the shareholders, so it's not going to be a profit. It's going to be a reduction in assets and a reduction in retained profit, as it's called. So our accounting transactions balance will keep, even though we're paying dividends to the equity holders. So profit, if a company is very profitable, then that means that the ownership interest, and that's profit after payment of interest and whatever to supply, and payment of not all suppliers, but some of the suppliers. That profit is due, means money's due to the owners. That's what we mean by profit. So where a profit is made, that means that the equity holding will have increased, and that profit will be in the form of a range of assets, whatever they spent the money on. It may actually be money, but it's not necessarily money. You know, if you say, oh, I made a profit, you mean you've made it in the form of money. Well, for a company, that's rather different. They may have made a profit, but it may not be in the form of money. And that creates obviously a management problem of cash flow proportions. And that's an important difference between our common understanding of a profit and a company's understanding of a profit. So yes, it's an increase in liabilities, but not necessarily from a profit, but not necessarily in the form of cash. It may just be debtors. A lot of people owe me money. I made a profit. Well, that's how it is in accounts. Obviously, it leaves open the question as to whether those debtors are actually going to pay you or not. And that is a crucial aspect of business. This just makes the point that equity and profit, reserves or retained earnings, we've been talking about it in that way, that is the ownership interest of the shareholders, and the liabilities represents other investors. And that's the credit side of things, and this is the debit side, the assets. Classification of assets, as it says there, if you go back to the Tesco balance sheet, you'll see all the elements of the assets broadly described. Here we are, current assets, inventories, that's stock, trade and other receivables, debtors, loans and advances to customers. Done quite a bit of that, but I think they've got some sort of credit. You can get a loan from Tesco's, can't you? Derivative financial instruments. Oh, well, we're not going to be talking about derivatives. It's not a very big part of their balance sheet. Tax assets, we won't worry about. Short-term investments, cash and cash equivalents. So anything that can be readily turned into cash. Non-current assets, goodwill and other intangible assets for which we can make a valuation. Property, plant and equipment, investment property, investments in joint ventures, other investment loans and advances to customers for more than 1 year. Generally, non-current assets are items beyond 1 year. Current assets, current means within the next year. And for what it's worth, we have current liabilities here, payables, that's creditors, suppliers, that sort of thing. Short-term borrowing, less than a year. Derivatives, we talked about that. And then the non-current liabilities, long-term borrowing, derivatives, slightly out of the money. And then benefits to employees rather, and tax owed, and various provisions. Right? Provisions are reserves that are made out of profits, saying we're not going to count this as increase in equity wealth. We're going to take this element of profit and shift it into provisions. And I was looking for a transaction that is purely on this side, and that would be one of them. To shift money out of our profit account and into reserves would be both a reduction and an increase on our creditor side. So we've had a quick look at the Tesco balance sheet. Current assets, I think we've covered these items. Expected to be sold within the next year. Yeah, sort of. Cash is current assets, and we're not selling cash. It is there for trading reasons principally. That's the case. Companies are buying and selling, and what they're making possibly or buying is going to be a current asset if they're going to sell it on. And it includes cash or near cash, and we've had a look at that. Non-current assets, just all the other assets. As it says here, mainly buildings, goodwill, machinery, fixtures and fittings, and as we saw with the Tesco accounts. We've said current assets are being held for trade to sell, and hence we make the sale here. We get debtors after we make the product, we sell it, that turns into debtors, and hopefully debtors turn into cash. So sales here into that, then they made the payment, then cash, and then possibly with the cash we make purchases. So Tesco knowingly delayed paying money to suppliers in order to improve its own financial position, the Supermarket Ombudsman has found, and there's the reference. So to include that, we have to make this point and say that we purchase goods, but we don't pay for them, right? Or Tesco don't pay for them. That goes into stock. In the case of a retail operation on the shelf, it's then sold. That creates debtors, trade debtors. Now, a retail operation gets its payment almost it gets it immediately from the till, though if it's on a credit card, there'll be a delay. So it's a shorter payment. But in a lot of business-to-business selling, an invoice is produced saying you owe us this amount, we supply it, so you supply it with an invoice, and you have 30 days to pay, would be a typical payment requirement. Then, so in 30 days, so for a while it's a trade debtor, and then you hope that your debtors pay, turning it into cash, and with the cash you pay the creditors, those who have are waiting for payment, and for certain large companies that can be a long time. The supplier is in a difficult position because they think, well, you know, I'm not being paid, but it is Tesco, it is a big company, it's a big order, we do rely on them, we don't want them to go elsewhere. And Tesco have been accused of exploiting this by delaying payment. The longer they delay payment, it's a form of financing the company. They're borrowing money from their suppliers, and that's thought to be very unfair because Tesco is a large company and the suppliers are much smaller companies, and they can't afford to have a debtor sitting on their balance sheet for ages because they are small, and any cash flow problems is going to directly threaten their existence. So this has been a common problem for the last, I would say, at least 30 years, and it surfaces every now and then. So this is the working capital cycle in its full form. Classifying current liabilities, we had a little look at that, and current liabilities very much the same definition of current assets, except that the company owes money to these people rather than the company is owed, and within the year. Non-current liabilities, just everything else, the borrowings and theoretically the shareholding as well. Usually it refers to borrowings. Loans for medium 3 to 5 years, not a set definition, plus long-term bank loans and things like that, and bonds. So those are the non-current liabilities. This is a stylized balance sheet. We've been looking at an actual one, but you can see the same elements. I mean, it is quite amazing that on one page, Tesco have summarized all their assets. Tesco is a huge operation, and they can summarize it in virtually the same number of pages as a corner shop. And it is an amazing condensing of information. So we have the elements here that we've been talking about, non-current assets and current assets. Those are the kind of headings, the traditional headings that lie under these classifications. Liabilities, long-term borrowings, non-current, and then trade payables, or creditors as they're often called, should be the main element of current liabilities, and that gives us our total equity. Oh, sorry, I forgot to mention equity. That's the total claims. Going back to our original equation, total claims 147. We did briefly mention the layout, and we said that Tesco's produced the total assets minus the liabilities, which is that plus that. The red indicates that the total is reduced, and that equals the equity. Alternatively, we can have something like this. So we just add up the total of our assets equals equity plus liabilities, and you know that's one way of looking at it. In both cases, the red equals the blue, so it balances, but they're just ways of different forms of layout. There was at one time one debate on which is the better layout and things like that, until somebody pointed out, well, actually, the stock market is a very sophisticated market. People have PhDs in rocket science looking at these things, and quite frankly, if you present it like this or present it like that, doesn't make a scrap of difference. The market has always been shown to be efficient in the sense that it can interpret information quickly in an unbiased manner. That doesn't mean accurately, but any errors it makes in estimating its relevance to the value of the company is not consistently negative or consistently positive. It's just, on average, is accurate, but there's quite a wide spread on the judgments that is possible implications. So it's what we could say unbiased. In your any statistics course or any module involving statistics, you ask the lecturer about what does unbiased mean, and he will explain it in numbers. We've been saying all along that the published accounts require a certain number of conventions. They're controlled. They have to be controlled. What Tesco reports should conform to accounting standards, and those accounting standards are developed out of basic concepts, and these are some of the basic concepts. So the business entity convention, we've been saying the business is a separate legal entity that you can sue, you can take to court. It owns things, right? It is the legal owner. The business is the legal owner, not the shareholders. The shareholders are the owners of the business. But you would sue the business. You can't sue the shareholders, and that's why it's called limited liability. Right? The liability is limited to that of the company. So that's the business entity convention. Dual aspect convention is our accounting equation. Every transaction involves either an increase in liabilities and an increase in assets in the same number, or an increase or decrease in an asset, or an increase or decrease in a liability. And that sums up all the nature of the dual aspect. The equation must balance. Going concern convention, we assume that the business is not breaking up. If the business is going to start selling off assets, that can often result in a different valuation. You may say, well, it shouldn't do. It should be the market value, and there's only one market value. Well, true, but this is practice, and if we're going to assume that you're going to be selling a building, then you've got to go and value it at today's prices. So you have to be careful, because some of these assets are not actually going to be at market value, and investors who asset strip companies exploit this difference. They buy up the company and they just break it up and sell it off, and the total of the market value of the assets, if it's greater than the balance sheet value, and the sellers didn't realize this, then the asset stripper is going to make a big profit. I worked for a company that had that was in the suburbs of Reading, and it had a very big car park which could have contained a housing estate. Now, eventually, after I left the company, they did sell off this factory, presumably for housing, and made a big profit. So one must be very careful about the valuations that you see on the balance sheet. And in certain circumstances, the difference with the market value is going to be significant. Allied to that is the prudence convention, and that is we don't include profits until they have been realized to a certain level. And we don't necessarily give the latest valuation. We prefer that if in accounts, if we're going to make an error, we prefer that it's an error of underestimating value and underestimating profit. So there is a deliberate bias in the accounts, and it's known, it's recognized, and investors can adjust accordingly. They will know that there should be no nasty surprises in the accounts where they find that something wasn't worth what it showed in the balance sheet. So that's a deliberate bias. And the historic cost convention is that we do pay particular attention to how much we paid for something, because that is factual. Everyone can agree on that. And generally accounts don't like going too far away from that concept. That has merely added in all the aspects that I've been talking about. The accounts are a measurement system, as we said at the outset. Measurement is not simple. We've been saying historic costs are a good guide. Some things are difficult to value, not surprisingly. Goodwill and brands. If you buy a company with a famous name, you may pay money for the name or for the brand name. And that's not a physical asset, it's an intangible asset. And we saw intangible asset valuation on the Tesco balance sheet, I think it was. So that how do you measure that? We tend to resort to the historic cost convention. How much did you pay for it? Human resources. Some businesses have fantastic employees, and a multinational might buy up that company, not for its assets, but for the employees. They want the intellectual capacity of the management there and the skilled workers. That value does not appear on the balance sheet because it isn't really sufficiently tangible, and it is very difficult to value anyway. So the conservative convention means that it doesn't get recorded, but the marketplace will know about it, or an efficient market should. Then monetary stability. In times of inflation, of course, values can very easily get out of date, particularly for fixed assets. So that is again a problem in accounts, but it hasn't been a problem for the last 20 to 30 years. So you're probably thinking, oh, well, it's not relevant. But inflation in the UK has been as high as 25%. So that's in 1 year, prices going up by a quarter. And that did happen over 1 year, not a calendar year, in the late 1970s. So inflation is always a possibility. Asset valuation, we've mentioned these points at various times. The preference for historic costs. There is a concept of fair values if they can be reliably obtained. That is a change in the value, usually as a result of readily accepted market transactions. Non-current assets, finite lives shown at cost, less accumulated depreciation. We've not mentioned depreciation. That is the loss in value of a fixed asset. Machinery, for example, has a set life and it will have lost value. So that loss in value we call depreciation, and we take that amount and we reduce reduce it and reduce our profits as a result, and the reduction in profits is then transferred to a reserve called depreciation. Excuse me. Then we have this rather odd phrase, non-current assets with impaired value, written down to recoverable amount, otherwise known as bad debts. That would be one of the main elements of that particular aspect. So somebody may owe you £5,000, but they've paid you £2,500 already, and you don't expect to get any more than that. You'd have to write off the other £2,500. Banks are particularly vulnerable to this kind of problem. Then inventory is shown at the lower of cost or net realizable value. So if your stock has lost value over time, then clearly you need to recognize that and write it off as a cost to the profit and loss account. So how do we use the balance sheet or statement of financial position? It shows how a business is financed, yes. It can provide the basis for assessing the value of a business, yes. Relationships between assets and claims can be assessed, yes. Performance can be better assessed, yes. So you can, as we shall be seeing, tell all sorts of things. You can see on average how long it takes debtors to pay, how long you take to pay your creditors. So it's surprising how much information you can get out of a balance sheet, but we will reserve that for future lectures. So have a look at a financial statement, as we said in the first lecture. But this time, identify the assets, liabilities, creditors and debtors, and think about the profitability of the company and the risk it's facing. We're going to be focusing on those aspects in later lectures, But it's always a good idea to have just a free look at the problem without any guidance, and use some common sense and your own ideas to make the problem more familiar to you. So you can have a look at that, as well as, of course, doing your preparing your seminar studies. Right, thank you.